Hi, Ed. Thank you very much for joining us today. How are things in Long Island?
Fine. We've had a pretty good winter. We didn't have much snow. I think in Canada, you guys, my daughter's down in Toronto, so she keeps me apprised of the weather up there. But here it's just been cold, but now we're waiting for spring. It's almost here.
Yeah, it's almost here. You are so right about the weather in Toronto. I think the amount of snow we got this year was historical. Probably the most snow I've seen in 15 years, which is
Wow.
great if you're a skier, but it's long gone. That's the good thing about Toronto. It's so far south that winter leaves pretty quick.
Good.
So we got a lot to discuss in a short period of time, so I want to jump right into it. And
Sure.
last couple of weeks have been historical, I guess. The volatility we've seen in the last couple of weeks has certainly been historical. In a 3-day period, the U.S. financial markets lost over $10 trillion, which is a mind-blowing number.
Yep.
Not only have we seen massive moves on the downside, we've seen some massive moves on the upside. One day this week, the Nasdaq was up 12%, which is just astonishing. Biggest one-day move since January of 2000, if you can believe that.
Yep.
And the VIX has also it ripped. I think it got up to 52 this week. It pulled back, with this massive
Hmm.
move in the markets. But the price action has everything to do with the trade wars and the tariffs that were
Correct.
implemented. And Jeremy Siegel, professor of finance at Wharton, has said the tariffs and the way they were implemented was the worst economic policy in almost 100 years. And I want to start right here and get your thoughts on the tariffs and how the whole tariff program was implemented.
Well, I would agree with Professor Siegel that it wasn't implemented very well, but I think it's premature to declare that it's a failure. I mean, this is an ongoing process. As long as relatively quickly leads to reciprocal tariffs that are negotiated down, that might actually be a good thing. But clearly, the implementation has been sloppy. It's obviously hurt the market. Look, I think we should put this all into context here, and that is President Donald Trump wrote the book on the art of the deal. I think there's some question whether he actually wrote it or had a ghostwriter, but clearly he wouldn't have put his name on it if it didn't reflect his views way back when. And what we're watching is negotiations the way they're done in New York real estate. It's not pretty. There's a lot of screaming and shouting, but it's all done behind closed doors, you see. And so when it's done behind closed doors and then they come out smiling, shaking hands and saying we got a great deal, then everybody thinks, that doesn't know all the things that were going on behind the door. The difference now is everything is being done in public and it ain't pretty to watch. Um, but we've also seen that as a result, it leads to a lot of ups and downs, and we're sort of privy to the screaming. Um, but I think we'll also be privy to how this thing all settles out. And I wouldn't give up hope that this too shall pass in a relatively happy way for all concerned. I think we've got a little bit of reprieve between the United States and just about every country in terms of negotiating, but there's still clearly an escalating trade war going on between the United States and China. So the coast isn't clear for sure.
That's why I like speaking with you because you're always so optimistic. So,
Well, somebody's got to do it.
so let's talk about the S&P. The last time you and I spoke was in December of 2024. I can't believe it was only a few months ago. It seems like years now, but at that time you were very optimistic about 2025. You
Yeah.
took your target on the S&P up from 6,000 to 7,000. And then in March of this year, you trimmed it to 6,400. Is that still the case?
And then about a week later, I trimmed it again down to 6,000. So yeah, I went from 7,000 to 6,000. Obviously, I, like everybody else, concluded that this tariff thing was going to be a bigger deal and linger longer than anyone had expected. I mean, on April 2nd, so-called Liberation Day, I think the markets were anticipating that on balance, tariffs would come in around 12%. And instead, they came in on average around 25%. So that was a real shocker. And then the president in his blustering way, said these things would be hard to negotiate because not only were we focusing on the actual statutory tariffs, but we were also focusing on non-trade barriers. And when they came up with this cockamamie formula that devised overall tariffs for almost every country in the world, including an island or two that just were populated by penguins, everybody was sort of in shock. But then the markets took a dive. And then over the past few days, the bond market reacted poorly. And the president got the message and did the right thing. He postponed for 90 days the tariffs on everybody except the Chinese. So in terms of the market, I'm going to stick with 6,000 by the end of the year. I'm moving my 7,000 to next year. I think we're still in a bull market. I mean, we came pretty close on the S&P 500 to having a bear market. I'm not telling you it can't still go there, but I think this will pass. I think within the next 3 to 6 months, the tariff issue will be much less of an issue. I don't think we're going to go into a Smoot-Hawley depression situation, and I think we'll move on to other items on the Trump agenda, like extending the tax cuts. I think it's important to realize that it's not really going to be a massive tax stimulus. It's just going to be extending the tax cuts. So it's not going to be super stimulative, but it's better than letting the tax cuts lapse. And then we'll be talking about deregulation and more U.S. exports, particularly of energy, and hopefully much better relations with Canada and Mexico. Again, Trump has this bullying style, but I think at the end of the day, it's also one that's turns out to be realistic, and he's pretty good at declaring victory, even though the ultimate results aren't exactly what he wants. But that's the art of the deal.
So let's look at your S&P target now. And right now, the S&P is trading around 23 times earnings. And in the last 5 years, the range is somewhere between.
Depends on earnings, right? We lowered our numbers from 285 to 260 this year. We lowered them for next year from 320 to 300. So we still have very positive outlook for earnings. And so we're using 300 as the number because the market looks forward. So 300 times 20 would give us 6,000. And I'll admit both of those numbers are on the optimistic side. But as you said, I do have that bias. I think the downside is kind of what we saw, maybe something a little under 5,000. But I don't think we're going to revisit that anytime soon.
And that's what I was going to ask you, because if we do get a pullback in the economy, we got Q1 numbers coming out here in the next couple of weeks. It's going to be interesting to see what happens. Maybe the real pain comes in with the Q2 numbers. But I'm just wondering if we get a big contraction in the economy and also in earnings, if we see the S&P go to 5,000 or maybe 4,500.
Well, we're in a big roller coaster here, not just in the markets, but also in the economy. And it's going to be, I think, a strange year for economic growth. I still think that a lot of the weakness in the first quarter, and we're looking for about 0.5 to 1%. I still think a lot of the weakness in the first quarter had some to do with weather. January and February were the coldest months, even seasonally adjusted especially in many years, and that certainly depressed retail sales and some other areas of consumer spending. The March data is looking better. We think retail sales are going to be very strong in March. Auto sales were extremely strong in March, and they'll probably be very strong in the second quarter because a lot of people. I mean, there's certainly a tariff still on autos of 25%, and that's will lead to increases of $5,000 to $10,000 in the price of cars, unless Trump changes his mind, which is always possible. But I think we're already seeing people scrambling to buy cars before the prices go up. So I think there'll be other sort of buy in advance motivations for better consumer spending in the second quarter. So it could actually be 2.5 to 3% growth in the second quarter, and then things could fizzle, and then that's where the debate is whether they're going to be negative numbers or positive. I'm right now thinking more like 1.5%, with a plus sign rather than negative sign.
Yeah, my kids are encouraging me to go and buy a new iPhone before the higher prices kick in because the iPhone I have now is 8 years old. They
Okay,
always laugh at me.
take their advice.
In fact, my son said he's got I think it's an iPhone 15, and he wants to get an upgrade later this year. He said he's going to sell me his old one.
Well, that's good.
So I want to ask you about the volatility we've seen in the markets here in the last week or 2 weeks. And when I look at the market now, to me, it's very reminiscent of what we saw in 2000, 2001, just in terms of the volatility on the downside and also the upside. And I mentioned earlier that we had one day this week when the NASDAQ was up 12%.
Yeah.
And when you look at the best 25 days on the NASDAQ ever in terms of percentage moves, 22 of them came during the dot-com bubble. And I
Hmm.
know this pullback that we've seen in the S&P and the NASDAQ has only begun, in the last few months. But I'm just wondering if you see any signs, or does it remind you of the dot-com bubble when we had these massive down days, massive up days, but the overall trend is down?
Well, I think it's a different environment. I mean, clearly there's similarities, and people have made the similarity between dot coms and data centers, and there's a lot of mixed opinions on data centers. The Bears got very excited when Microsoft announced that they were canceling some of the data center contracts they had, and apparently somebody else jumped in and took them. We're still building data centers, and I think we're still very much in the digital revolution that started in the mid 1960s. And the digital revolution is all about processing as much data as we possibly can, as fast as we can, as cheaply as we can. And as we are able to do that more and more, with the evolution from the IBM mainframes to PCs to the cloud and now to AI. It's all about processing data. And as we can do that faster and faster, cheap and more cheaply, guess what? We find more data to process. So I think the digital revolution is all about data, and there's lots of it. And the demand for technologies that can process all that data, come to conclusions with all that data, is just going to continue to increase. So I don't see this as a dot-com kind of bubble. And meanwhile, the companies that have been leading the technology boom here in the stock market do in fact have earnings. A lot of the dot coms didn't, and the dot coms had to get cash. They burned through cash. Nobody's really burning through cash here, at least not cash that they can't get more of. And then, of course, we've got a situation where the, um, the companies that are spending on data centers are basically cloud companies. So everybody kind of, I think we're focusing too much on AI and not enough on AI as being part of the digital revolution. And AI is just being another application that requires that we continue to increase the capacity of the cloud.
Yeah, these AI platforms are amazing. Do you spend much time on them?
I've been using them more and more right now, kind of fairly elementary level as research assistants. It's basically kind of the next iteration of Google. Instead of
Yeah.
searching on Google and getting individual links, you get a story, and if depending on what you're using, increasingly these LLM models do provide you the link to the original story, so you can check it. I mean, we still have to watch out for hallucinations and errors being made by this technology, but it's relatively new, and a lot of money is being spent on it. So yeah, we're increasingly using it, but we were hoping that it would unemploy us. We were hoping that we'd be able to, have it write our morning briefing and just sit on the beach and collect the check. But it required too much effort to double check these things. So we still write the original piece.
Yeah, I've pretty well used most of them. The one I keep going back to though is Chat GPT. And I'm just amazed at how fast it can throw an answer at you, regardless of the subject matter, right?
Yeah.
And to your point about Google, like Google's becoming archaic pretty fast. And in the
Yeah.
last couple of quarters, they said their searches are down significantly. So they better get their act together because they're gonna.
Yeah, absolutely. But the other point about the late 1990s is the big excess wasn't actually dot coms. It was maybe the second biggest excess. The big excess was telecommunication companies, WorldCom, for example, that sold a lot of their equipment as using solar financing. It's always easy to boost your sales by offering your customers that you'll give them all the money they need to buy your product, and so there was a lot of that going on.
Yeah, the other name I remember well is Global Crossing, and they were trying to lay fiber optics across the world. So that's a good overview of the S&P. You're very optimistic overall, and I want to move on to bonds now. And we've seen a lot of volatility in the bond market here in the last few weeks. The yield on the 10-year was gone from a low of 386 up to 435. Not sure where it is now, but it's probably around that 430 level. But you recently came out with a report titled "Is Something About to Blow Up in the Credit Markets?" So I want to get your thoughts on the volatility we're seeing in the yields and also the credit markets.
Yeah, that piece actually came out on April 9th, and April 9th also happened to be the day that Trump did a pivot uh, on his tariffs. And yeah, it actually came out April 8th in the evening, and so we were looking at the high yield market, saw that the spreads were starting to blow out. Looked at the bank loan ETFs, and they were starting to take a dive. And so we were pointing out that the mess in the stock market, which Trump administration officials had made light of, was now going into the credit markets, and that the bond vigilantes were now saddling up and about to cause some real problems in the credit markets. And that seemed to get the attention of the administration because they've said that they care more about the 10-year bond yield than they care about the stock market. They've expressed some really cockamamie ideas about only the wealthy own stocks. So, the wealthy have gotten the wealthier on Wall Street, and now it's time for Main Street. I mean, I got news for them. A lot of Main Street is involved in the stock market, either directly because they're day trading, or they own stocks directly, or they have IRAs. They got pensions. I went to get my haircut on over the weekend, and everybody in the barber shop was like miserable and just talking about how much money they lost in just a matter of a couple of days in the stock market. Even the barber was. So I didn't know the income profile of the people that were getting haircuts, but everybody was upset about it. And then I had, spring is here, so I had my sprinkler guy come to the house to open up the sprinklers, and he was saying, "Ed, what can you do about this market? It's killing me." And so I think that the stock market has a very powerful wealth effect on consumer spending. But in terms of policymaking, it looks like the bond market convinced the administration that they had a problem. They didn't want a credit crisis. They didn't want a credit crunch. I don't think they want a recession. And Trump specifically said that he was concerned about what was going on in the bond market. So in some ways, the bond vigilantes saved us, and in many ways, what's just happened in recent days shows that the Trump put is back, because that's what happened. I mean, Trump created the crisis, and then Trump created the Trump, came in with a Trump put and said, well, I'll pivot, slow it down, and that helped a lot.
And as you know, there's $37 trillion of federal debt that has to be funded or refinanced. A large chunk of it's coming due this year. What's the exact number? Do you know that has to be refinanced this
I
year?
think it's about $9 to $10 trillion.
Yeah, so it's a huge number, and of course they're trying to get interest rates down so it can lower their interest cost. But they're having a tough time doing that, especially after the last week.
Yeah.
But do you see a threat of rates going higher? Like you talk about these bond vigilantes, like maybe they say, you know what? 430 doesn't cut it or 450 doesn't cut it. We want
Yeah,
5% or we want 5.5%. Do you see
right.
that threat at all?
Well, I think we've had a couple of episodes like that, where the bond yield's gone up, and as you said, uh, we had a couple of years ago where it went up to 5%, and there were plenty of buyers that jumped in there. I mean, it's a market, it's a freely traded market, and uh, there's always going to be a yield at which there'll be buyers. And in the case of the recent move, we got, I think, up to 4.75%, and there were buyers there, notwithstanding the fact that there was no particularly good news on the outlook for the supply of securities. I've been doing this for about 45 years, and over this period, uh, the, the the doom and gloom about debt, the government debt, has been ongoing. I coined the phrase bond vigilantes back in 1983, and every time bond yields go up, I get a call from reporters or accounts saying, "Is this the bond vigilantes doing their thing again, trying to establish law and order in the credit market? If because the sheriff's not doing it, the Fed's not doing it, the fiscal authorities aren't doing it." Um, and I've got a collection on my bookcase, top shelf. I've got about 20 books on the debt bomb, living beyond our means. When I wrote that, when I came up with the phrase bond vigilantes back in 1983, I went back and reread what I wrote, and I forgot that I mentioned that the bond vigilantes are concerned about deficits of 200 billion, not trillion, not 2 trillion, but 200 billion. So we've come a long way. Not a happy course in terms of how much debt there is, but the world has not come to an end. We haven't had the doom, and so my attitude towards this issue is I'll worry about it. I'll worry about the debt when the government when the bond market worries about the debt, when the government debt becomes harder and harder to sell. And right now, it's been going reasonably well. I think the past few days, the 3 year at least auction was sloppy. The 10 year should be okay. But all in all, there's it's still a very wealthy world, and there's a lot of wealth around the world, and wealth wants to be diversified, and there's still a lot of demand for government bonds. Let me tell you a quick story here. I have a lot of investors who manage money for wealthy individuals, and every now and then, the money managers tell me that their clients are particularly upset. They want to get out of the stock market either because it's going down or because it's going up, and they feel like they've made enough money, and they're conservative. Wealthy people want to keep what they got. They want to get a decent return. So if they want you to get out of the stock market, why? And the answer is usually because they don't like the debt. They don't like the way the government's running things, and there's too much government securities, and they're worried about the debt situation. So if they want you to get out of the stock market, what do they want you to buy? And they say, oh, they want us to buy 10-year treasuries. So it's like, well, what? They're concerned about the government debt, and the first thing they want to do is buy what they still view as a safe asset, which is a 10-year treasury.
So we've seen a lot of volatility across different asset classes this week, and the one that really surprised me too is the US dollar, because quite often when we get a pullback in the stock market or the bond market, a lot of money flocks to the USD, but even that's been down. It's down like is measured by the Dixie index or the DXY. It's down 6% on the year. Do you think this is a referendum against the US?
Well,
Some of the programs that have been implemented in the last few
yeah,
months?
sure. I mean, the stock market, the bond market, the foreign currency markets, they get to vote every day. That now it's 24/7 on a global basis. So the financial markets are always providing some sort of opinion on the policy making, and that's why I've expanded my co coinage of terms from bond vigilantes to stock market vigilantes. I thought the stock market vigilantes would. I think we all thought that Trump would care about it. The study came out and said he doesn't care about it, but then again, he still cared about the bond vigilantes. And then, of course, there are the currency vigilantes that are constantly giving us a vote of confidence in the way policies are run by countries, by governments around the world. But if you look at a chart of the dollar, it's just been kind of moving sideways with volatility. So, 1 or 2 days doesn't really get my attention. But clearly, there's a lot of controversy about the dollar. This is another one that's, and for most of my career, people have been predicting the demise of the dollar as a reserve currency, and maybe it's losing some of its influence to gold, for example, as central banks are clearly buying more gold. But I think all in all, I wouldn't conclude that the dollar's about to go into a dive.
And I believe it was during the last Fed meeting, Jerome Powell left rates unchanged, but he did cut growth rates for the U.S. economy to 1.7% from 2.1. He
Yeah.
also took inflation numbers up, and once again, it has to do with the uncertainty associated with tariffs and a potential
Sure.
trade war. But are you concerned about the U.S. economy at all? Do you see it slowing down? Does it go into recession?
Yeah. Well, since 2019, I've been predicting that this decade would, with the benefit of hindsight, be called the Roaring 2020s, obviously alluding to the 1920s. And I got the first half right. Now I'm working on the second half, and people remind me always that the 1920s ended very badly with the Smoot-Hawley tariff, which I think was the major event that caused the Great Depression. So I guess it's conceivable that the analogy is all too accurate. It's just on speed. It's happening faster. So we already have the Smoot-Hawley tariff with regards to U.S. policy vis-a-vis trade. But as we said before, it's a little premature to conclude how this thing ends. It doesn't have to end badly, as a lot of people still think. A lot of people think that so much damage has been done just in the past week that we're never over going to, we're not overcome it, and we're still going to head into recession. I just disagree with that. Economy has been remarkably resilient for 3 years. As you know, over the 3 years, I think I was alone, or maybe I had a few other economists out there predicting that the economy would be resilient and we wouldn't have a recession. So I look at that experience and say, well, it proved itself quite nicely in its resilience to the tightening of monetary policy. Maybe it'll do the same here with this uncertainty of policy making by the administration, with this tariff zigging and zagging. And I'm still holding to that. It's just this year kind of could be a sloppy year, but I still think it's going to be the roaring 2020s with technology boosting productivity, which in turn boosts real growth, keeps a lid on inflation, is bullish for the stock market, and so on. I'm looking for 10,000 on the S&P 500 by the end of the decade. I think companies are their earnings power is going to increase as productivity increases. But for here and now, I did raise my odds of a stagflation recession scenario to 45%. At the beginning of the year, it was at 20%. Then a few weeks ago, it went to 35%, then 45%. And I was borderline thinking about saying, okay, let's go with the flow. Everybody else, JP Morgan went to 60% and others went to a recession. And I kind of held back. And so far, so good. I told people who were asking me what to do with this sell-off, I said, it's too late to panic. And I said, just hang in there with your portfolio. I think it's going to come back. And we got a lot of relief in one day on April 9th, but I think the volatility is still going to be with us for a while. Maybe the second half of the year we'll start moving back into record high territory.
So you're right about the inflation, and one of the things that I really enjoyed seeing this week was this pullback in oil. That helps us all
Yeah, it's
because
great.
you
Unless
went,
you happen to be Canadian and selling it and trying to sell it.
yeah. But listen to this: how much are you paying for a gallon of gas in Long Island?
I don't even know. I think it's because it's been moving quite a bit. I think it's somewhere close to $3 or three and a quarter.
Yeah. So one of the great things about I'm sure you've heard we have a new prime minister.
Yep.
The first thing he did was he got rid of this carbon tax, which was basically a gas, which was in the gasoline price. And so it brought it down significantly. So with this pullback that we've seen this week, and with the removal of this carbon tax, the price of gas at the pumps is down about 25%. So
Mhm.
it's gone from $1.60 a liter down to 120, which I think with the FX, and when you convert it over into gallons, it would be about 3.30 a gallon. So
Mhm.
big pullback for us, which is good. And that's the cheapest it's been in a very long
Yep.
time, but we're still paying significantly higher than what you're paying. And also our neighbors in Michigan, I think they're paying like $3, 2.50 to $3 a gallon.
Mhm.
But so that helps out a lot. Now, what about Europe? Do you have any thoughts? Because as you know, we're seeing all this money leave U.S. financial markets. It looks like a lot of money's flowing into Europe. And you look at the DAX. I haven't heard anything positive about the German economy in years,
Right.
but yet the DAX is up. It was up 15% on the year. I think it's still up about 7 or 8% on the year.
Mhm.
Do you
Well,
see this flow leaving? Do you see money leaving the US going
mhm.
to Europe?
Well, again, you always want to be careful about overanalyzing and coming to, major investment conclusions on a few days of trading, especially these days where everything is so volatile. But I've been recommending what I call stay home uh, for global investors looking stay home, meaning overweight the United States. So for U.S. investors, obviously stay home. Other investors overweight the United States. I've been saying that since 2010, and there've been zigs and zags along the way, but the trend's been solidly to the upside when you look at the ratio of the S&P 500 or the MSCI US relative to all country world. Clearly, there's been a strong upward trend. We've just kind of retested that since the beginning of the year. I think it's going to hold. I'm still recommending overweighting the US relative to going global, relative to underweighting the US and overweighting the rest of the world. And as you said, the German stock market had a rip-roaring rally on the notion that, hey, the Germans actually are going to spend money. They're going to, borrow money. They're going to deficit finance more defense spending and maybe some more infrastructure. But the economy still looks terrible over there. They're getting killed by competition from China. I mean, their auto industry is facing some real challenges. And the Chinese have become probably the world's best manufacturers of electric vehicles, and the electric vehicles have taken off around the world. Not so in the United States so far, but and they're working on new technologies. One company apparently has claimed that they've got faster charging batteries. That'll make a huge difference to demand. And the Germans just aren't keeping up with that, and they're not competing effectively with what the Chinese are doing. And speaking of China, people have also poured money into the Chinese market, and it said, "Oh, there's AI companies there, and with DeepSeek, we want to be in Chinese AI companies." And so that took some of the steam out of the AI companies in the United States. And then people realized, well, wait a second, these are just AI companies, and if there's a challenge from DeepSeek to U.S. companies, it's the same thing for Chinese companies. I think at the end of the day, AI is going to be a great productivity tool for companies that use it as opposed to companies who sell it. But it's going to be a great product for cloud companies because we're going to need more and more computing power. But go back to China because I kind of drifted from that country. But back to China, um, it's really perverse because one of the successes of Trump 2.0 is for how many years has the United States been trying to prod the Chinese government to stimulate consumer spending so they wouldn't be so reliant on dumping their goods in global markets and putting all the rest of us out of manufacturing business, and they just wouldn't listen to us. And now all of a sudden they're scrambling to try to stimulate their consumer. I don't think it's going to work. the demographic profile is way too geriatric. Old people just don't go anywhere. They don't buy as much as younger people with families and looking out further into the future. So I'm not gung ho on China. I'm not gung ho on Europe. Yeah, a case certainly can be made for India, except that, it's not like it hasn't been discovered. And I guess you could certainly find good companies in emerging economies in Canada and other places. But I would still overweight the U.S. I know people have given up on the notion of American exceptionalism, which is a not a I don't really like that phrase, but it does get us to the question of, what's so special about the United States? And I think, to be specific and try to be objective, not nationalistic about it, our capital markets are probably the best in the world. They're very, very well developed. I'm not going to tell you that we are supreme in technology in every area and that we don't face competition from China and South Korea and Taiwan and other places, but we're right up there in terms of technological innovation, and that's partly because the capital markets are so have so much money to throw at innovators, at entrepreneurial capitalism. So we have that going for us. We got plenty of energy, as you folks do. We're now starting to. We have been exporting more of it. We'll export more of it, even more of it as natural gas to Europe. Got lots of farmland. I mean, there's a lot going for the United States that I think still makes it relatively exceptional. And entrepreneurial capitalism is still thriving in the United States. I think more so than any other place. I think it was thriving in China for a while until the Chinese government concluded that the Chinese Communist government decided that the entrepreneurs were getting too wealthy and too powerful, so they started to really put a noose around them. So that's where I am.
Many valid points, and one of the great things about the U.S. is technology, right? To your point, I mean, nobody can compete with them, and that's one of the things that's killed us in Canada because we're a resource-driven country. 30% of our GDP comes from exports. Most of that's resources. But if you look at Canada and you compare it to the state of California, population right around the same, 40 million people. I believe the state of California, its GDP is around 3.5 trillion. Canada's is 2.5 trillion. So,
Mhm.
so the big difference there, it's all technology. And that's one of the things that's really killed us. And if you look at the Canadian economy in the last 10 years, under the leadership of Justin Trudeau and the Liberals, our GDP has grown by 1.5%.
Yeah.
Can you believe that? Versus the US, which is around 2.5%. And then when you look at it from a GDP per capita point of view, the disparity is even wider. It's like
Yeah.
US, where is it? $80,000 per capita.
Mhm. Yeah.
Canada's is like below 60,000. Okay. So it's just we have some real problems here. But hopefully we're going to have a change in government here in the coming election. We have an election coming up at the end of the month. We'll see what happens.
Yeah.
But Ed, I want to thank you very much for this conversation. It's always a pleasure speaking with you. And
Thank you.
before I let you go, if somebody would like to learn more about you and read some of your research, where can they go?
Well, it's easy. You go to yardeni.com if you want to see both have a trial of either the institutional product or the product for individual investors. The individual investors would be yardeniquicktakes.com. And that's really designed on a daily basis to give you an insight on the relationship between the macro economy and the financial markets. And we're very interdisciplinary. We look at all the interactions of the various markets and kind of say which is giving us the right signals and might have an impact on the other markets.
And Ed, you have a very extensive library there. Are you reading any interesting books?
Well, right now haven't been reading much, but I've been listening to Audible books, and I don't know why, but I recently got kind of interested in dictators. I listened to one on Stalin, and now I'm listening to one on Mao, and I think we should all be listening to those kind of books just to realize how good we have it. I mean, it's tyrannies are murderous, literally.
Yeah, I tell my kids this all the time. We live in one of the best countries in the world. The
Yeah,
politicians are never perfect. They're always going to be flawed.
always.
But I think regardless of the party that's in power in your country or my country, it always has to do with the men and
Yeah.
the women who get up every day and they go to work and they grind to pay for the rent, put food on the table, and that's what makes
I yeah,
your country.
I want to second what you just said because that's kind of one of the messages that I try to convey in my work that I've learned over the years is, when people look at the U.S. and say, it's amazing how well the U.S. economy and stock market have done despite Washington.
100%. And if you look at the last 100 years, the trend is up,
Yeah,
right?
trend is up.
Anyhow, Ed, once again, thank you.
Thank you.